So before we start, it's probably worth pointing out we have a guide for every single one of our ratings. They're over here on the left-hand side. If you click on Training and Guides, and again click on Guides just underneath it, you've got guides to FE Fund Info ratings, and there are currently 4 of them. You've got a guide on our Alpha Manager rating, guide for the Crown rating, guide for Risk Score, which we'll be talking about today, and the Passive Fund rating as well. And if you click on any one of them, it will provide you with a nice little PDF, and it will summarise how the rating's put together, why you'd use it, and some information on the underlying logic we use to create them in the first place. So diving straight in, our FE risk score is pretty agnostic in the sense that we will risk rate absolutely everything. It just really depends on how much history that investment solution has. Generally between 18 months and 3 years we'll need to calculate and compute a necessary FE risk score. And you'll see on the left hand side here I've selected an array of different solutions just to labour on that point that we do risk rate everything. I've got a direct equity with Vodafone, I've got an index, I've got a model portfolio, and I've got a fund sector. Now there are lots of different ways of getting at and sourcing the FE risk score, but there are no better ways of getting it very quickly just simply by clicking the fund fact sheet next to the item on the left. So I'll start off with the equity. If I click on the fact sheet, you'll notice one of the first bits of information you'll see on that fact sheet is indeed the FE risk score, and in this case 157. So what does that mean exactly? Well, we'll come back to the main screen first. So our risk score starts at 0, which is cash, and it does technically go on forever. There's no ceiling, but most funds will max out at 150. Direct equities will of course be much higher and can be much higher. And we've pegged the FTSE 100 at 100. So by the time you get to an FE risk score of 100, you are ultimately taking the same risk as an investment solution that is 100% equity exposure in one country. So you can consider 100 to be pretty risky. Now by anchoring the FTSE 100 to 100, it allows us to create a relative measure of risk as opposed to an absolute measurement of risk. And that's important. We could, in theory, select any benchmark to create that relative measure. We decided to go down the route of the FTSE 100 because the FTSE 100 is going to be known by most people, and it obviously conveniently has 100 in its title, so we can peg it to that level of 100. The difference here is when I'm looking at other investment solutions and I'm specifically maybe looking at a volatility measurement, that's considered an absolute measurement of risk because it goes up and down like a yo-yo, independent of everything else. But when I'm looking at a relative measure of risk, yes, that investment solution might be getting a lot riskier, but if the markets in general are getting riskier at the same intensity, then really it shouldn't move. It's going to be relatively stable. Now, there's no right and wrong whether you want to look at an absolute measurement of risk or a relative measurement of risk, but it obviously pays to have both available to you. And in our point of view, it's probably a bit easier to try and explain the relative risk of one thing against another using a relative measure. So to illustrate what I've just said there and how we peg the FTSE 100 to 100, and indeed another quick way of extracting the FE risk score from analytics and the historic FE risk score as well, on the right hand side there is actually a chart for that. So you've got FE Fund Info risk score chart, type in a particular year period, click on generate chart, and again it will show you the relative risk of everything against one another. The FTSE 100 will always be a flat line at 100, and I can see very clearly that the equity takes a hell of a lot more risk than the FTSE 100 as you'd expect. And down here I've got my well diversified model portfolio and a well diversified sector of multi-asset solutions. So how can we harness that FE risk score at fund level to work out how diversified a portfolio is? Well, you do that within a portfolio itself. So again, back on my main screen on the left hand side here, I've got my model portfolio 4, so that's a good starting point. I'll just left click on it and open it up. Now you can see once the portfolio loads up, so long as your underlying holdings within that portfolio have got an appropriate FE risk or at least an appropriate level of history attached to them, you'll see at the very bottom you've got this diversification benefit box that loads up. If I don't do it much justice in this tutorial, feel free to click here and read more, and that will provide you with a really nice guide that actually explains the diversification benefit in great detail. And equally there's actually a little PDF icon that will allow you to actually PDF that little box into a bigger PDF to provide to a client. Now ultimately what it's trying to do is working out the FE risk score of the underlying holdings, working out how much risk they should theoretically generate if we're looking at a fairly basic average, and that's this second figure. And under current portfolio risk score, that's the actual risk you're experiencing as an investor. And the difference between those two figures is 18%. On our scale, we believe that's a medium level of diversification. Now, another way of explaining that would be if every single one of the funds within your portfolio, here I have about 9 of them, if each one of those had an FE risk score of 80, I think most lay people would expect that the overall portfolio FE risk score would be 80. Seems sensible. If every single one of my funds carries an FE risk score of 80, surely the average would be 80 as well. But that's not how you calculate and again compute the level of risk associated with a portfolio, because it's not just the sum of its parts, it's what the parts are actually doing and reacting against one another. So yes, every single one of my funds could have an FE risk score of 80, but because they're so different to one another, because there's such a low level of correlation between them, it creates diversification. And what does that mean? Well, diversification means it's going to lower the level of risk. So yes, if we worked out a very basic average on this particular portfolio, the level of risk you'd expect would be about 80, but that's not the level of risk you actually experience. The level of risk you experience is 66 because of that diversification impact in your portfolio, and therefore again, we think that's exhibiting a medium level of diversification. Now, it's worth noting that the scale there, low, medium and high, isn't necessarily going to be the same for another portfolio you look at that's only got a diversification benefit of 18%. Don't be surprised if you look at another portfolio that has a diversification benefit of 18%, showing that you've got a very high level of diversification. And that's because the scale underneath there is actually dynamic. It's looking at your portfolio and trying to figure out if it's actually easy or difficult for you to create diversification. And a good way of looking at that is if you're looking at a balanced portfolio, it's naturally going to be easier for you to create diversification, because by virtue of being balanced, you're probably going to be investing in all those different asset classes. And by virtue of you investing in lots of asset classes, it's going to create organically a load of diversification for you. So if you're only managing to get 18% diversification from that portfolio, we're not going to classify that as being particularly high. But alternatively to that, you could be investing in a portfolio that predominantly invests in maybe equities with very little exposure to those other asset classes, and naturally it's going to be a lot harder for you to create diversification from that portfolio. And therefore, in our opinion, maybe an 18% for that portfolio we would consider quite high given the makeup of the portfolio itself. And again, there's no right or wrong here. There will be people with a large amount of conviction that the markets are moving in a particular way, and therefore they won't value diversification. They want to be investing their investment pots in a particular way to harness a particular maybe area of the market that they think is going to do well, and therefore those portfolios might have a low level of diversification. But again, that's not to say that's a bad investment strategy, but ultimately most investments and most investors are going to want a well diversified investment strategy to limit the level of risk they're taking akin to their risk profile. There are, of course, lots of ways in analytics to show diversification in action, and it's not just our diversification benefit ratio. You can actually use things like scatter charts, for example. So coming back to this main screen, I've grabbed my FE model portfolio. This would work on pretty much any portfolio. I've selected the 2 tick boxes to the right-hand side, so I want to look at, yes, the overall model, but also equally all the underlying holdings. And I want to create a 5-year scatter chart. And what I'll get is something a little like this, where I've got my green dot that shows my overall portfolio sits, and the black dots are showing where all of the underlying funds of my portfolio sit. Now, interestingly here, it kind of goes back to what I was saying a few moments ago about diversification and how it reduces the level of risk. If I couldn't see that green dot there, and all I had to go on was the black dots, and again, I asked a layperson where they thought the average risk would be if I invested in all of these different funds, they'd probably put the green dot somewhere around this line. And makes, again, logical sense. If I'm investing in all of these little funds, all these little black dots, then if that one takes that level of risk, that one takes that level of risk, and the least one takes the least level of risk over here, then my green dot is probably going to be somewhere in the middle. But obviously, again, that's not how risk is calculated. It's looking at all of those funds against one another and the combination of those funds and what they're actually doing to in terms of diversification. And in this case, it's lowered the level of risk of my portfolio to the extent that the actual risk I experience as an investor, as you can see down here, is 6% volatility. There's only one fund in my portfolio that takes less risk than the overall portfolio. And again, that's a nice way of kind of explaining how diversification works. It's not just simply the average of all of my holdings, it's a lot more than that. If you actually wanted to look at correlation, which is ultimately the underlying measurement we're using to work out the level of diversification, you have got a correlation table on analytics, and this works with anything, again, not just with portfolios. But coming back to this main screen, I've got the same portfolio that I was looking at a second ago, trying to show how diversified it was on a scatter chart. And this time I've disabled looking at the overall portfolio. I'm not too fussed at looking at that at the moment. I just want to look at the underlying funds that make up that portfolio. If I go to the tables tab on the right, go and select correlation table, select a particular period of time. When you're looking at correlation, 3 years is usually sufficient. Click on generate table and you'll get a nice little correlation table that basically pitches every fund against one another. All of the funds along the left, all the funds along the top. And again, it's looking at correlation. So anything positively correlated, anything that's behaving fairly similar to one another, anything above 0.7 is going to be blue. Anything exhibiting a low level of correlation against one another is going to be green, and anything negative is going to be red. If you think of a system looking at all of these relationships of all the funds against one another, that's what our FE risk score diversification benefit tool is doing. It's looking at all of these numbers, crunching it all together and trying to work out how diversified that portfolio is investing in this collection of funds. So I hope that tutorial has been useful. As ever, you've got the help desk in the bottom right, the live chat facility, if you have any questions on this, and equally on the left hand side under contact us, there are details to contact them via phone and email. And just again, as a recap, you've got training and guides on the left hand side as well, that not just go through the ratings that we have on analytics, but also all of the features on the right hand side, including the scatter chart and the correlation table we went through.